Imagine having money that grows quietly in the background while you sleep. Not from luck, not from risky bets, but from a system designed to build wealth over decades. For some people, that system is a trust fund. For others, it's index investing. One often sounds like something only the ultra-rich have, while the other is available to almost anyone with a small amount of money and patience. But here's the surprising truth. Both rely on the same core principle: long-term disciplined investing. Understanding how trust funds work and how index funds grow wealth could completely change how you think about money, inheritance, and financial security. Part 1. What a trust fund actually is. A trust fund is not just a pile of money handed to someone when they turn a certain age. It's a legal structure designed to hold and manage assets for the benefit of another person. The person who creates it, called the grantor, places money, property, or investments into the trust. A trustee then manages those assets according to specific rules, distributing funds to the beneficiary over time or under certain conditions. Trust funds can be used to pay for education, living expenses, healthcare, or long-term financial support. While they are often associated with wealthy families, trusts can be created with modest amounts as well. Their true purpose isn't luxury, it's control, protection, and structured wealth transfer across generations. Part 2. Why wealthy families use trusts. Wealthy families use trust funds primarily to preserve wealth, not just pass it down. Without structure, large inheritances can disappear within a generation due to poor decisions, taxes, or unexpected events. Trusts allow the grantor to set rules that protect the assets. For example, limiting withdrawals, requiring education milestones, or spacing payments over decades. They can also shield assets from creditors, lawsuits, or divorce settlements in some cases. Another key benefit is continuity. Even if the original wealth creator passes away, the trust continues operating according to their instructions. This ensures that money supports future generations in a controlled and intentional way rather than being spent quickly. In essence, trusts transform wealth from a one-time transfer into a long-term financial system. Part 3. What index investing is. Index investing is a strategy that focuses on buying funds designed to track the performance of an entire market rather than trying to pick winning stocks. Instead of betting on one company, you invest in hundreds or thousands at once. These funds mirror major market indexes, giving you broad diversification automatically. Because they don't rely on active management, index funds typically have very low fees. Over long periods, they have historically outperformed most actively managed funds. The philosophy behind index investing is simple. Markets tend to grow over time, and capturing that growth consistently is more reliable than trying to beat the market. It's a strategy built on patience, discipline, and the power of compounding rather than speculation. Part 4. Why index funds are so powerful. The real strength of index funds comes from 3 factors: diversification, low costs, and long-term growth. Diversification reduces risk because your investment isn't dependent on any single company's success or failure. Low fees mean more of your money stays invested and compounding over time. Even a small difference in annual fees can translate into huge differences in wealth over decades. Most importantly, markets have historically trended upward over long periods despite short-term volatility. By staying invested, you benefit from economic growth, innovation, and productivity increases worldwide. This combination makes index funds one of the most efficient tools for building wealth steadily without requiring constant monitoring or financial expertise. Part 5. How trust funds often invest. Many trust funds don't sit in cash. They are frequently invested, and index funds are a common choice. Trustees have a responsibility to manage assets prudently, balancing growth with risk. Broad market index funds provide an ideal solution because they offer stable, diversified exposure without excessive speculation. For long-term trusts meant to support beneficiaries over decades, this approach allows the principal to grow while also generating income. Some trusts distribute only the earnings while preserving the core assets, ensuring the fund can last indefinitely. In this way, a trust fund becomes less like a static inheritance and more like a self-sustaining financial engine designed to support multiple generations. Part 6. Trust funds versus personal investing. While trust funds are structured and managed by trustees, personal index investing gives individuals direct control over their own financial future. You don't need inherited wealth to use the same principles. Regular contributions to index funds can replicate many benefits of a trust over time. The key difference is discipline. A trust enforces rules automatically, while personal investing requires self-control to avoid panic selling, overspending, or chasing trends. However, the long-term outcomes can be remarkably similar. Someone who consistently invests over decades can build a portfolio large enough to support retirement, fund education for children, or even create their own family trust in the future. Part 7. The role of time in both strategies. Time is the most critical factor shared by trust funds and index investing. Wealth rarely grows overnight. It compounds gradually, then accelerates. Trusts often exist for decades or even centuries, allowing investments to compound across generations. Individual investors can harness the same force by starting early and staying consistent. Even modest contributions can grow into substantial sums if given enough time. Conversely, delays dramatically reduce the final outcome because compounding has less time to work. This is why financial experts often emphasize starting as soon as possible, even with small amounts. Time transforms ordinary savings into extraordinary wealth. Part 8. Common misconceptions. Many people assume trust funds guarantee effortless luxury or that index investing is too slow to matter. In reality, both require patience and careful planning. Trust funds can impose strict limits, meaning beneficiaries may receive modest payments rather than unlimited access. Similarly, index investing doesn't produce instant riches. Its power lies in steady accumulation. Another misconception is that these tools are only for the wealthy. While large trusts do exist, smaller trusts and low-cost index funds are accessible to middle-income families as well. The true barrier isn't wealth, but knowledge and consistency. Understanding these tools opens opportunities that many people overlook simply because they assume they don't qualify. Part 9. Building your own financial legacy. You don't need to be born into wealth to create a legacy. By investing regularly in diversified funds, managing spending, and planning long-term, you can build assets that support not only yourself but future generations. Over time, those investments can be structured into estate plans or trusts if desired. The goal isn't just personal comfort, it's stability, opportunity, and security for those who come after you. Many self-made families follow this exact path. Earn, invest, grow, protect, and transfer. What begins as disciplined saving can evolve into generational wealth. The earlier the process begins, the more powerful the outcome becomes. Trust funds and index investing may seem worlds apart, but both rely on the same simple formula: diversified investments, long-time horizons, and disciplined management. Whether you inherit wealth or build it yourself, these principles can help turn money into lasting security. If you found this helpful, like the video, subscribe for more practical finance insights, and share it with someone who wants to build real long-term wealth. Your future self, and possibly your future generations, will thank you.